as we step into 2026, the market presents both opportunities and challenges. So what's the right approach for investors today? In the next few minutes, let me guide you through what's driving the market, the key risks to watch, and where opportunities are emerging, so you can start the year with a clearer perspective. I would say that the current market environment is on the complicated side, which is the reason why the market is very volatile. I think on the good side, we have valuations of stocks at very depressed levels, which of course is one of the reasons why you want to buy stocks today. The problem is companies, although their profits are growing, they face a lot of risk. Okay, and that kind of explains why sentiment is so weak, and we have a lot of companies, for example, during the first 9 months of 2025, delivering lower than expected profits. Although that said, profits are still up. I think for the first 9 months of the year, median profit growth is still at around 5%. So it's just that it's not a clear-cut, strong market. But I think that just means that the market is bottoming out at this point. It's just that there are so many risks facing the market, which is why sentiment is so poor. I think one of the major indicators that investors are watching out for right now is the GDP growth. I think, for example, GDP growth in the third quarter was really very disappointing. And I think one of the reasons why a lot of people are bearish about 2026 is that they expect GDP growth to really stay weak as the government spending remains depressed. But, for example, Finance Secretary Go said that the government will do its best to, ramp up the spending as soon as the first quarter. I mean, if that happens, then that's, I think, will be a good driver for the market. Another potential catalyst would be fund flows. So in case you didn't know, the foreign funds are actually flowing into emerging markets. And actually, the EEM ETF is actually up by more than 30%, which is better than the performance of the US market. And why is that? Well, cheap valuations, which is something we have. Aside from that, last year, remember, we always talked about the weak US dollar. So if funds continue to flow into EEM to the point that other emerging markets have become expensive, then inevitably they will look for other countries that are cheaper, and we are part of that emerging markets, and we could see the markets or the Philippine market trading at a higher valuation. So the catalyst for this to happen or to continue happening is a weak US dollar and a stronger peso. I think for the risk, well, first of all is economic growth. It could continue to disappoint. Well, but as we've discussed earlier, that is not surprising. I think most investors are already anticipating that. But for me, like one risk that I've been talking about for already quite some time is a potential weakness in the US stock market. So one of the reasons why we did see more flows into emerging markets last year is the US market continued to trend higher, although weaker compared to emerging markets. But, next year, there are more and more concerns that there could be the bursting of the AI bubble, and aside from that, a possible recession of the US economy. So if those things happen, the US market is quite expensive, then we could see the US market go down substantially. And unfortunately, if that happens, we could see a contagion into the Philippines. Okay, opportunities. Well, I think high dividend stocks will continue to be attractive, especially with an environment of falling interest rates, these high dividend stocks will continue to, I guess, be of interest to investors. These would include your power companies like Aboitiz Power and utility stocks such as the water companies. They give good cash dividends, and they are also defensive. So in case economic conditions remain weak, more or less their profitability will stay stable. And we've also talked about the banks, which we feel will deliver stronger profits this year. So we think there are opportunities in the banks as well. And aside from that, the power companies, which are trading at very cheap valuations and are showing some signs of also bottoming out. So I think those are the opportunities that we have right now. Well, I think, for investors, it's important to realize that today is an opportunity. I mean, there is always an opportunity during times of crisis. But, given how volatile the market is, I understand that it is hard to stay invested. But I think the secret to staying invested and to be able to withstand the volatility that is happening right now is, risk management and controlling the size of your portfolio. So if you are a new investor, like, don't go all in. Just set aside enough. Set aside an amount of money that you're sure you will not need. I mean, this is not a market for traders that you expect to make a lot of money. But I'm quite confident that if you hold on to your stocks for a long period of time, you definitely will make money. Secondly, okay, I understand that it is quite difficult, and I think a lot of people right now are talking about value traps, like the Philippines could be a value trap. So for you to avoid, potential value traps, make sure to buy stocks that pay cash dividends. So at least you know that the company that you're buying is actually unlocking shareholder value, or you're actually benefiting. Because it just means that if a company is being ignored and its profits actually go up, then they will pay you more cash dividends and they will not be ignored by the market and by investors. So those are the things you can do. Control your size, make sure that it's money that you will not need in the short term. And second is to focus on companies that know how to unlock shareholder value by paying out cash dividends. That's your snapshot of the market, its direction, key drivers, and opportunities. For regular market updates, stock insights, and investor guidance, stay tuned here on our COL YouTube channel. Thank you for watching.